2023 meeting of the Retirement System Investment Commission. Before we get started and get things rolling, I'm going to ask our CEO, are there any housekeeping items or you need to adjust or clean up the agenda at all?
No, sir, nothing before.
Good. All right, so I'll take a motion to adopt the proposed agenda.
So moved.
May I have a second?
Second.
I have a motion and a second to adopt the agenda before us. Any discussion? All in favor, please say aye.
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 Any opposed? We have an agenda. All right, next up is the approval of the minutes from the September 14th, 2023 minutes. May I have a motion to approve those minutes?
So moved.
I have a motion to approve the minutes. May I have a second?
Second.
I have a motion and a second. Is there any discussion on the minutes from the meeting from September 14th of 2023? Hearing none, all in favor of accepting these minutes, please say aye.
Aye.
Opposed likewise? We have approval of the minutes. All right. Next item on the agenda is the chair's report. I have no information for the commission. Next is committee reports. Both the Human Resources and Compensation Committee and the Enterprise Risk and Audit Committee met this past cycle. Those reports have been posted. Are there any questions about those? Hearing none and moving on, I'm going to turn this over now to Mr. Hitchcock for our CEO's report.
Thank you, Mr. Chairman. The only thing that I would have of note for the commission is you'll see, I believe everyone in their packet should have a list of the meeting schedule for the next year, for the next calendar year. Our first meeting in 2024 will be on March 7th. Then we'll meet again on April the 18th, June 13th, September the 12th, and December the 12th. So I just wanted to make sure that everybody was aware of that. And that those will ensure that we'll send an electronic copy to everybody so we can get it, and meeting invites to make sure that it's on everybody's schedule. And we'll also post these on our website as well. So, and that is all that I have, Mr. Chairman.
Thank you, Mr. Hitchcock. With no questions for him, next up is our Chief Investment Officer's report. For that, I'm going to turn it over to Mr. Byrd.
Thank you, Mr. Chairman. As is our custom, at the end of the first and third quarters, we do a fiscal year review. And at the end of the second quarter and full fiscal year, we tend to do a longer term performance review. So this is going to focus on the last 3 months. Let me start with the high level here. Our portfolio declined during the quarter by nearly 2%, with some modest outperformance of the benchmark. Interest rates obviously continue to rise. Most interest rates were up nearly 1% during the quarter. And that is really what continued to weigh on almost all of our asset classes. More on that in a minute. I don't want to sound like a broken record, but the increased contribution rates still continue to benefit the plan and drive down. This is why this is really important, because it drives down our liquidity risk. So what do I mean by that? If you look in the 1 year column, you can see that our net benefit payments for the last year were $238 million. Even compared to this is less than that 1 year number was 12 months ago. So we are seeing meaningful improvement to the liquidity position of the plan. Let me shift.
Hold
Yes,
on,
sir.
we have a question, Mr. Condon.
Thank you, Mr. Chairman. If you could go back one slide.
That is a great question if I can.
Yeah.
There we are.
Okay, I appreciate it.
All right, that's your question.
Was that the question?
Give you a softball to start off with.
Perfect.
All right.
All right, 1 for 1. I like this.
Now T-ball. The quarter quarter is positive though. 17, is that something we're gonna see, or is that a timing difference of some sort?
So there's a legislative inflow. At the beginning, it hits, I think, in the first 2 weeks of July
It's like
every
at the
year.
at the very beginning of the fiscal year, we get it's about 100, I think it's up, isn't it 100, it's about 110 million?
Yeah.
Right, that we get. And that was, the General Assembly picked up the first 1% way back when, when they instituted the increased contributions, the General Assembly picked up the first 1%. And so we just get that as an inflow almost immediately
Okay.
at the beginning of the fiscal year. So that's why that's positive.
All right, very good.
So it's not going to continue.
It's not going to repeat itself quarter after quarter, but it has been hitting.
Once a year.
It has been hitting in the first quarter for the last 5 or 6 years.
Since
I would say.
the 2017 legislation went into effect. Right, because in the budget, when they passed that legislation in 2017,
But aside from that, the long-term annualized trends are very encouraging. Is that going to continue?
So the other numbers are not annualized, those are cumulative.
yeah, those
Oh,
cumulative.
okay.
So, so over 3 years, essentially, that we're averaging 450 million per year over the last 3 years. So those are cumulative.
Oh,
So
okay, okay.
What was the peak? Like,
It's like,
the peak was
Peak was
close to
like,
1.2 billion, I
Yeah.
think.
that was artificial.
some of that was,
It was around 2018 or so when the Terry program
And a whole bunch of people.
ended/expired, and there was a lot of exits.
But it was north of a billion.
Yeah, it
on
was.
an annualized run rate for a couple years. David can probably help get us that number.
yeah, it was, I mean, I think if you think of it kind of more of a percent,
Yeah.
they would about 3 to 4% run, it was about running about 3 to 4% of AUM of plan value.
That's right.
All right, so that's the, you can kind of think of it that way, and now it's,
Yeah.
less than,
And just,
hovering around, close to 50 basis points of plan value.
and relative to when in 2020, we adopted the asset allocation, that is our current asset allocation, even relative to then, the 238 million is around a third of what it was. So our liquidity need to service the benefit payments to plan participants is not only is the plan value higher, but the dollar amount is about a third of what it was. So those two things really help make it much simpler and more straightforward to service the liabilities out of the kind of dividend and interest payments that we receive in the public part of our portfolio. So it's really made a big difference in terms of how we manage the plan, but also when we enter the next discussion about asset allocation, we're gonna start that discussion from a very different starting point, just relating to that. So, Mr. Condon, is there anything else on this?
No, sir.
Okay.
Thank you.
All right, so moving into our performance framework, you can see here during the quarter, we outperformed both the reference and the policy portfolios. And while both diversification and portfolio structure decisions added value, we did give up some of that in what we categorize as the manager selection. So looking at asset class performance, a few things I think are noteworthy, and this is the only place I think that I'm really going to deviate from looking only at the first quarter. But stocks and bonds, interestingly, doesn't happen often, where both are down meaningfully and just about the same amount. We've seen a much higher correlation between the two over the course of the past year and a half. Our real assets benchmark was down again this quarter, which if you recall, that is a core real estate benchmark. And that is, I forget if it's the fourth or the fifth quarter in a row where we've seen a negative return out of real estate. Our portfolio, though, includes a good amount of infrastructure. A little more than 3% of the plan is in infrastructure, and our infrastructure portfolio has really done quite well and has, as you can see, made a real meaningful impact in the returns, not just during the quarter, but over the last 12 months as well. Our private debt portfolio, interestingly, is the top performer for the quarter, but underperformed its benchmark. Sometimes a lagged public benchmark makes you look really smart, and sometimes it doesn't help you. We're in a period, not only this quarter, but when we look at this at the end of Q2, since it's a lagged benchmark, we already know that it is going to be a even stronger benchmark return for the next quarter. So that is a bit of a challenge for us to keep up with that right now. But if we are able to do it, that would be a tremendous outcome. So finally, Portable Alpha, which, to remind you, we are showing the return stream for Portable Alpha is not the return for the hedge funds. It is the return for that hedge fund portfolio less the return of the cash rate. So, but it too added value during the quarter. You can see that when you look back over 12 months, it's been kind of a non-event for us in terms of value add though. So I mentioned I'm going to cheat for a second here and talk about longer term things. There are two things that I frankly don't think I've seen before since I've been here. One is when we look at the 3 and 5 year returns, the worst returning alternative asset is that the asset class is outperforming public equity, which is the best returning listed kind of traditional asset class, both 3 and 5 years. Second, I'll call your attention to the bonds line where the benchmark is negative for 5 years. It's actually, if you go back 7 years and you own the benchmark for investment grade bonds, you have lost money, this is a powerful thing that's happened in terms of rising interest rates. And that's kind of the epicenter of where it's been hurting our portfolio. I don't want to.
Hey, Jeff, can I ask a question?
Of course.
Real quickly?
Of course.
Can you go back to that slide before?
Is that the question?
Previous slide? No, that's not the question.
There we go.
That was a question, but here's the second one.
The question.
Part B. I looked at for quarter public equity and bonds, both are at negative. Is that just interest rates or what's?
Yes.
It's usually doesn't one go the opposite direction of the other?
Exactly. Normally, when you have stressful environments with that adversely affect public equity, typically you see bonds hold up pretty well. This is a bit of a different situation because rising interest rates is what has been causing the concern for not only will the higher interest rates tip us into a recession, but also just kind of generically, higher discount rates tend to depress asset values for any and all risky assets. So that is, broadly speaking, the difference here is that the problems are being kind of caused by interest rates as opposed to interest rates are the safe place that you can kind of park your money while you wait for the storm to pass.
That was even
Mark,
more
do you have-
profound and magnified if you think back to just 2022, the calendar year, when stocks were down almost 20% and bonds were down 13%, which was one of the worst years on record for those two asset classes combined, the 60-40 portfolio.
Yeah, there were a lot of articles about the death of the 60-40
Right.
portfolio. Let's be clear, we are not cheering for the death of the 60-40 portfolio because we have, as you can see, more than 60% of our assets in stocks and bonds. So that is not something that, when I point out that over 3 and 5 years, the alternatives have outperformed traditional assets. I bring that up because that is not the normal state of affairs. But that is one of the benefits of having a diversified approach, is we are not relying on just simply one or two asset classes to drive our returns. So,
Question.
yes, sir.
Right.
Let's delve into bonds a little bit more. So the quarter was negative 3%.
Yep.
But 1 year positive.
The benchmark, yes, was up 64 basis points.
But even if you look at the actual, it was much closer to zero.
Mm-hmm.
So the year was much better, and that to me is reasonable because it really seems like maybe it was during that quarter, this 9/30 quarter, when rates really started to increase or whatever. But then I look at the 3 years, it didn't seem like rates were increasing much during those 3 years. That seems more like a current event. I'm wondering.
They actually were increasing, but
Were they?
here's what happened. You go back into the pandemic. So the pandemic hits in March, and rates bottomed in, I want to say, July, Brian, if I'm not mistaken. But when rates bottomed, the 10-year yield hit something really close to 50 basis points.
Mm-hmm. It went south of that.
Yeah. So that's the flight to safety that you normally expect to see to some extent. So everybody bought bonds, yields got crushed. So all we've had is things move back to kind of more normal levels. We have definitely a very strangely shaped yield curve right now, but all yields, every point on the curve, is substantially higher from, September 30th was not the bottom because yields had bottomed shortly before that. But it's the story of 3 years of just things kind of returning to normal, and that's terrible for bonds. So that's why -5 on a 3-year basis that's losing a good bit of value over that time. And as I alluded to, if you just look from September 30th backwards, you have to go. If you go back 7 years, your return is still negative. So you have to go back into that 8th year ago, and from that point to today, that's how far you have to go back to have a 0% rate of return in investment grade, but the safe thing in everyone's portfolio. It's kind of wild that we've had that outcome, but it's not all that alarming that eventually people were going to want more yield than 50 basis points on a 10-year bond.
Right.
And one of the reasons why our portfolios performed well over the last 3 years is not only have we had, off benchmark exposure in the bonds portfolio is floating rate exposure. So we've had floating rate and we've been underweight bonds. And those two things, obviously, when we see that we're comparing to a -5, and our plan return is over 8 during those 3 years, that's a lot of what contributed to that. So.
All right, thank you.
All right, so I'm not gonna bore everyone to tears describing what attribution is again, but let's just get right into it. As far as our decisions on overweighting and underweighting asset classes, this is largely a story of everything was positive in the quarter, but think of it this way, everything that was good in this quarter that we're looking at is going to reverse in the quarter that we are actually in, the second quarter. So I don't want anyone to draw conclusions that this is going to continue. Then as far as how we implement our portfolio, overall, these forces are positive during the quarter, but I'll call your attention to the circles at the bottom. We measure both our listed real estate exposure and our infrastructure using publicly traded securities. So the way that our attribution works is we're looking here at how did two things that are public perform versus a private quarterly marking core benchmark. And public performed worse during the quarter, which I don't think is terribly surprising. Then on manager selection, this is where we gave back a little bit of value And I'll call your attention to I don't want to hit the wrong button. There we go. Down here, the bonds, that is a large negative number. And the reason it is that we are making our bonds portfolio, which has a below target weight allocation, we began to make it try to perform like a larger bond portfolio. So that means we bought longer duration bonds. So this is, frankly, it's bad in this quarter. It'll look the opposite in the next quarter. But I want to make sure I call attention to the thing that is the biggest factor in why the selection is negative. And that's not, don't think of that as manager selection. Think of that as I'm the manager and I selected that. So that negative 45 basis points is attributable to decisions that I made directly. Jumping ahead, this lists for you each of those factors. If you go horizontally, you can see how they all add up for an asset class. And as I alluded to, the bonds portfolio performance is, let's see if I do this correctly. The long duration is what we see in the manager selection. We were slightly underweight, but the positive 45 basis points comes from the fact that we are using mostly treasuries in that portfolio, and the quality component added there. So let me hit our compliance assessment, and you can see this is not a story that has changed much at all during the quarter. We continue to be overweight on the strength of performance historically in our private equity portfolio. So that is a situation where even after our secondary transaction, we are 1% north of our range. And of course, that is also contributing to being overweight total private markets, which we continue to flag for notification in our meeting. This is probably I don't want to, this hasn't changed, I'll just put it that way. The biggest change on this page is 0.1%. So this is largely the same story of risk as we saw at the end of the prior quarter. The big excitement here is that we had one number, which is this number, fall by 0.2%. So I don't want to breathe more into this. There's not a whole lot from an asset allocation standpoint that changed during the quarter, so it's largely a stable picture of risk. But let me pause there and see if there are any questions or comments.
As you know, private equity's coming down closer to the bands than it has been. Is it primarily due to the outperformance of public markets, public equities versus private equities, or have you been receiving meaningful distributions?
We have not been, until after the end of this quarter, been receiving meaningful distributions, but we have seen a few very large exits, which is going to help kind of keep driving that back to where we want that exposure. I shouldn't say where we want it. I'd love if private equity outperformed for 5 more years, and it was 20% of the portfolio, just on the strength of its own performance. But to your point, we haven't yet gotten to the point, I think, where we're seeing a lot of M&A activity and a lot of transactions that give us the opportunity to get our capital back. So
You're seeing more of that now?
Because
It slowed for a while, didn't it?
Yeah. We've seen a very large exit that is very meaningful to our portfolio, achieved by Brookfield, relating indirectly to a certain nuclear facility that, let's just say, is a pain point in South Carolina. But we have profited in a lot of ways, and we've had a very, very successful outcome for a co-investment that was also a big position in one of their funds, so.
But how's deal flow as a whole? Is it picking up?
We're seeing signs it's coming back, but not anywhere near to the levels that it was, 2021, 2022.
Both on the acquisition and the sell side?
Yeah, well, as people like to say, for every seller, there's a buyer.
Yeah.
So,
Yeah. What do you want to call it?
yeah, when that activity arises, we'll have some capital calls, we'll have some distributions come back to us, but we haven't seen that kind of normalize yet.
All right, thanks.
Yep.
And as we've talked about in prior meetings, I mean, all of your peers are kind of facing the same issues, and anybody who's had a meaningful allocation to private markets, private equity especially, is over allocated right now. It's just where the markets are.
Yeah. So, all right. Mr. Chairman, if there are no further questions, that concludes my presentation.
Thank you, Mr. Berg. Any more questions for our Chief Investment Officer? Hearing none. Mr. Hitchcock, would you read item 8 on our agenda, please? I think we need a motion to proceed into executive session.
Before that, Mr. Chairman,
Oh, I'm sorry.
Verus has a couple of presentations for us, so.
I'm sorry, Verus, I skipped straight over you.
That's okay, Mr. Chair.
Mr.
We're used to
Brubaker,
it.
my apologies, and the floor is yours, sir.
Okay, thank you very much. And I want to just make sure that my colleague Ian is on and able to hear and able to communicate with us.
I am on, able to hear, and able to communicate. Thank you, Mark.
Excellent. Well, thanks, Ian. And for those who haven't met Ian Toner, Ian is our Chief Investment Officer. He and his team are instrumental in all the investment work that we do as a firm. But in particular today, we're going to talk a little bit about our capital market assumptions, looking into out over the next 10 years and the market environment. We're going to give a very high-level overview today, both of the process for the asset liability study that we're going to really, I guess, complete in 2025. And we're also going to give a high-level description of how we come up with our capital market assumptions. But Ian is going to be here in person for the March meeting, and we're going to dive a lot deeper into the capital market assumptions and how we come up with our expectations for return and risk and correlations across the asset classes. So I'm going to talk, I think we're going to talk for less, probably combined 25 minutes or so. But I want to start out before I turn it over to Ian to talk about the capital market assumptions. I just wanted to give a very high level overview of the process, which really is going to kick off today. You could say it kicked off last quarter with discussions we've been having internally. And then again, it'll culminate in 2025 with the asset liability study and a new asset allocation policy pick. So on slide 2 here, this kind of, one of the things we've talked to each of you about, we had those individual phone calls to talk about education and where you might need more education or more description of how we do things. So starting today, you can see, as I mentioned, we're doing the overview of the asset liability process and the CMA process. Ian will be here in March 2024 to do a much deeper dive on our capital market assumptions and how we came up with those. In June of 2024, we're going to have a kind of a deep dive on the RSIC liabilities. Liabilities, as you know, that's a benefit payment stream. Those are the expected benefit payments out over the life of all of your participants, discounted back at the expected rate of return or the actuarial assumption on return. And we're going to do a much deeper dive there in June. September 24, we're going to talk about, Jeff talked about risk today, talked about it in the context of volatility or standard deviation. There's a myriad of risks that you as commissioners need to consider when you're setting asset allocation policy. And so we're going to do a deep dive on risks. That'll be inclusive not only of volatility, but illiquidity risk in the plan, the risk of inflation, headline risks that you might experience as commissioners, as well as behavioral risks. And those are just to name a few. And then in December of 2024, we're going to go through the role of asset classes. I know I've seen in your deep dives on asset class by asset class, Jeff and his team put together a really nice summary of, what role each asset class plays in the portfolio. Is it growth? Is it income? Is it an inflation hedge? We're going to go through that in a little bit more detail, and also introduce if there are new asset classes that we're proposing or that Jeff and his team would like to consider. We'll be doing some education on that as well in December. Any questions on that? I'm not going to go into detail on this slide. We've reviewed this before, the investing process. And just to emphasize that the asset allocation and asset liability analysis, it's one of the most important elements of the design phase. This is where you're going to pick the asset allocation policy, and that's going to drive over 90% of your returns and your risk in the coming years. And again, as we do this, the key inputs to the process, we've already touched on a bunch of them. The current financial position, obviously the funded status of each of the plans will be a strong determinant in input into the process. Your projected liabilities, so not only your current liability stream, but also your projected benefit payments and expected contributions will be modeled, and our long-term capital market assumptions. Those are the inputs. We have a number of modeling tools that we use. But then I think the key there at the bottom of the page are the decision factors, the outputs. We're going to look at ranges of outcomes. If you think about it, all of these models are good. It's called stochastic simulation. We don't need to get into the nitty gritty there, but basically based on all of those inputs that I mentioned, we can pre-experience different market outcomes, and we model over 10,000 different scenarios looking forward. And so you're going to see a lot of things couched as a range of potential outcomes. There's going to be an expected outcome, or a median outcome is a better way to look at that, and then a range around that.
Can I ask a question?
Yes, Bill.
And it might be more theoretical, but so if the key input is the plan liabilities, if I don't know the exact number, but let's say we're 56% funded. Well, say we were 40% funded. Would that mean that the outcome, the asset allocation simulations or calculations would tend to tell us to be more aggressive?
I would say they're going to give you a range of I think that's more of a subjective decision that as commissioners you would make to say, we want to try to grow our way out of this hole, or if you're in that deep of a hole, and as you experienced and went through the process, you're going to need contributions to help.
Yeah, I was going to add that, Bill, a lot of it would depend, like in that instance, would depend on what's the contribution policy, because, for instance, there's a fund that I think is somewhere in the teens funded status, but they're net positive on contributions because the employer contributions is like 80% or something like that. So it just kind of, it just kind of depends on, whether you're going to be more aggressive or less aggressive. Some of it's going to depend on what that net negative cash flow is and those types of characteristics.
Certainly that's helped us since
Yeah, right,
17.
yeah. But if you're net positive cash flow, then you're going to have the ability to be more aggressive and try to grow your way out of it. But if contributions stayed the same, then you couldn't be as aggressive.
Right.
Because you'd be worried about falling into that, we call it the event horizon, where you fall below the ability to be able to recover. Right.
But I think, don't you think that all that has to be tempered by the fact that trying to grow your way out of what you suggested by taking more risk, that has to be very, very carefully considered.
That is absolutely right, because if you think about what Jeff presented as far as your net cash flows as a percent of, we talked about it as a percent of total assets. As your funded status drops, your benefit payments as a percent of assets goes up dramatically. So you really would, as funded status goes down, I'd say the most illiquidity risk becomes one of the most important risks that you need to consider.
And Ed hit the hammer on the nail on why I asked the question, because if we're woefully underfunded, that doesn't mean we should go for a 9% return.
No.
We're fiduciaries, and we might be violating our fiduciary duty if we do that.
So
I wanted to make sure the liabilities themselves wasn't the driving factor.
And absolutely not. And if you look at it, when you're in that level, if you're, at 50% funded or in that ballpark, it's impossible to grow your way out. You're
Yeah.
gonna need contributions. So then you have to really dovetail everything, contribution policy, your risk tolerance, everything together into one asset allocation policy.
Like, for instance, Bill, I mean, I think we're at a, the amortization for SCRS, I think it's now dropped down to 16 years, right? And that's 8 years, I think it's 8 years ahead of schedule. That's what it's supposed to be under the legislation. There's two really big factors that have gotten us there. One is better, we forecast when the legislation was being enacted back in 2017, they used pretty conservative forecasts as to what they thought that the returns were gonna be over the course of the next 4 or 5 years. And we exceeded that. But more than that, I think is really just the amount of cash that was infused into the system, right? That's the real, kind of driver of why we've seen that much, acceleration in getting through that amortization schedule, right?
I've said this before, I think that's one of the best things you have going is your contribution policy. And I have another client, very similar in terms of funded status, very similar in terms of their overall asset mix. But they don't have, and they have employee contributions coming in, which is a really small fraction. The employer contributions, they can't rely on. They've had them pulled. So they don't necessarily even know, when we model their liquidity, for example, they have us model it at, let's assume 100% of the actual required return, or required contribution, let's model it at 50% and 0%, because they don't know if it's coming in. And that really hinders them as far as how they can invest over time. This next slide, I'm not going to go into detail here, but I did want to, I mentioned stochastic, and again, what stochastic means is based on our return assumptions, the risk assumptions, and the correlation assumptions, there's going to be a path of returns. And the path of returns, as we know, and as you see every quarter, as Jeff presents, it's unpredictable. But based on those metrics, we can give a range of potential outcomes. And so what we have here is just a sample. This is regarding funded status. This is not your funded status. This is just a hypothetical plan. But just to show you how to read those graphs, if we look at just this one, the white line in the middle there, that represents the median expected outcome. That means 50% of the outcomes would fall above it, 50% below it over a 10-year projection period. The top of the blue bar represents the top quartile of results. So 25% of the time results would fall above that, 75% of the time the results would fall below it. And the same thing at the bottom, that's 75th percentile. And then if you look at the what we call either the candlestick or the whiskers here, at the very bottom, that represents the bottom 5%. So 1 in 20 times you'll have a scenario that falls below that or falls above the top of the whisker. And you'll be seeing a lot of these kind of exhibits. You probably have seen them before.
Yeah, we include a similar type in our SIOP every year.
Right.
It just looks a little bit.
Or is this an example?
This is a pure example.
This is not, we're not looking at
Yeah, this is
Yeah,
our
our
system example.
Yeah, stylized example, right?
Yes. Just for, and then here's an example. We also do deterministic modeling. In this case, just on the right-hand side, the what if we have a negative 20% return in year one, which if this was modeled in 2021, you probably could have gotten there. And what happens from that point forward? So that's another type of analysis that we'll be presenting. And then scenario analysis and stress tests. So these are different types of tests. On the left side, you can see that we have different market environments, and we can take, your current asset allocation policy as well as, any proposed asset allocation policies and kind of run them through these different market environments. The COVID shock being the most recent one, the tech crash in 2000 to 2003. You could pick any time period you want, and we can run those portfolios through those time periods. Then on the right-hand side, the stress tests, we can shock global interest rates by 200 basis points. We can shock credit spreads. We can do any number of different tests there and see how your portfolio would perform in those kind of economic scenarios. And that's part of the output. And then finally, before I turn it over to Ian, this last one is the liquidity coverage analysis. I think this is really an important one. If you think about the way that the candlesticks or the whisker graphs work the same way, these are forward-looking projections and a range of outcomes. But we look at your liquidity, so what we take, the numerator of the equation are your current liquid assets, plus any expected positive cash flows. That's contributions, any distributions coming in from private equity partnerships. And then the denominator are expected cash needs or cash outflows, so benefit payments, capital calls from these private markets investments. And so what we do then is we shock your liquid assets to see how they, the overall liquidity of the portfolio would respond. And again, we have, different clients have different tolerance ranges for that, but we'll talk more about that as we go through the asset allocation process with you.
The description describes, greater than one is sufficient, but one's not what you want.
One's not what you want. So most of our clients said maybe two is a floor, of comfort level. And if there are no questions on the process, I'm going to turn it over now to Ian. Ian, I have the slides, so just tell me if we're on slide 10, and
Wonderful.
You can take it away.
Wonderful. I can see the screen, and good morning, everyone. Thank you for having us. It's a pleasure to be here virtually. I'll look forward to being physically present early next year. So the goal that I'm going to cover in the next few minutes is just to give you a brief run-through of how our capital market assumptions process looks like it's going to, the output of that is going to change year on year, and a little bit of a background in how we do that work. So as you've heard already, 2023 has been an interesting year. A bunch of things have gone in directions people didn't expect. And the result of that is that changes in our capital market assumptions for the next 10 years are driven in part by the changes in the underlying drivers of markets. So 3 key things to point out there. First of all, because the trend of rising interest rates has happened, fixed income asset yields are higher. And one of the key drivers over the long term when you're forecasting return for fixed income is the yield. So as you would expect, what that means is in a looking forward 10-year basis, that means that broadly fixed income assets have slightly higher expected returns over the next 10 years than they did last year. Second thing, domestic equities haven't materially changed despite the increase in rates. Valuations for particularly U.S. equities remain fairly stretched, and that pulls down the expectation. In fact, we're expecting a little bit more than half a percent reduction year on year in our capital market expectations for U.S. large cap. And then higher bond yields and expensive equity markets means that fixed income markets are more competitive than with U.S. equities than they have been for some time. You've had this inverted yield curve, the talk about a higher for longer interest rate environment, although over the last couple of weeks we've seen drops at the longer end of the yield curve. There's likely to be a fairly bumpy road in the short term in the fixed income space. Credit spreads have contracted slightly. Those are one of the key drivers of expected return in fixed income credit markets. And credit default activity has picked up from low levels and is now at fairly average levels. Of course, in the credit fixed income space, the yield you generate is reduced by the defaults that happen, so we have to forecast based on long-term historical behavior. We forecast both expected default rates and expected recovery rates, in fact, if you dig into the gubbins of the model. The end result of this is that one metric we use to measure the big changes is that the expected behavior of a domestic and a global 60-40 portfolio, just to get some kind of thermometer for where the assumptions are showing changes. And the answer is, on average, those are little changed from last year. Slightly higher bond forecasts, slightly lower equity forecasts, end result about the same, and a little bit lower for the typical domestic 60-40 portfolio than the long-term average expected return historical return for a 60/40 portfolio. So maybe if we move on to the next page.
Ian, can I ask a question?
There's three things.
Ian,
Please, go ahead. Yeah.
Ian, let me interrupt. I have a question from Commissioner Condon.
Please.
Yeah, Ian, on the previous slide, the second bullet talked about rising interest rates continues. And I'm no expert by any means, but few people, I think, expect the Fed to keep increasing significantly. Is that maybe referring to maybe the long end of the curve rising?
Well, so we're talking about a higher for longer rate environment. So rather than material rises from here, more the rapidity of the declines. And the market, the discussion that's going on at the moment is whether those declines will be rapid or whether they'll be somewhat slower than that. In other words, where are rates going back down to 1, 1.5, 2, or are rates going to be at the long end of the curve coming down to 2, 3, that kind of level, and will that decline be slower? So that's the discussion we're talking about rather than an expectation for much higher from here. Does that make sense?
Yes, sir. Thank you.
Any other questions? Okay. So for the inputs for the process that Mark was talking about and that we'll be working on with you over the coming year, we need to forecast expected return for all of the asset classes that are on the table. We need to forecast expected volatility, and then we need to forecast the correlation matrix. The latter two are mainly driven by historical observation of those relationships. The real focus of the process is on the expected return, and on that focus, on the next page, we look at the building blocks of each of those asset classes. So we go back to first principles and say, what are the key things that drive each of the asset classes we're trying to forecast? And in the appendix of this presentation, I think there's a slide that shows you each of the components we try and look at. So the building blocks added up give you the expected return. So, for example, this is a stylized approach. There's an income component you can expect from most assets. There's an inflation-driven component, and there's a real growth component. So the income component in equities looks like the dividend yield. The income component for bonds is the yield. The inflation component is a part of an equity return, and then the real growth is the real earnings growth for the equity market. And when you look at those over the long term, those tend to sum up to give you a long-term expected return for that asset class over time. So the nerdy process we go through behind the scenes is making sure we've identified the best way of measuring each of these building blocks for each of those asset classes, finding a good long-term metric, and then looking at what those add up to for the future. On the next page, the next few slides just run through how those key building blocks of some major asset classes have changed. The focus here is on the directionality rather than on the final number. Those final numbers, although the report has just been released, those final numbers will be the topic we come to next year. This is more a directional conversation. So U.S. core fixed income, how have those building blocks changed? Well, the rising interest rate environment that we have seen means that yields are a little bit higher. So that gives you a higher expected long-term return. But credit spreads have tightened. So the market's core fixed income has a degree of credit in it. The universal and various other more risk-orientated benchmarks have a larger amount of credit in there. So credit spreads have tightened, which means the expectation decreases a little bit. So the long-term expected return for fixed income has broadly been up by a little bit less than 1% across most of the fixed income complex, driven by mostly these two variables. On the next page, large cap equity. So this is a little more complicated. A dividend yield, higher valuations means yields have gone down a little bit year on year. Real earnings growth expectations have increased a little bit. There's been roughly no change in inflation expectations baked into market forecasts for expectations. But valuations have got a little bit higher. which damp future expectations. And so the end result of that is a slight drop in U.S. large cap equity and international developed large cap equity, which you'll see when the forecasts we go into the forecasts in detail.
Ian, can I ask a question?
Please, yes.
This is Jeff.
Please, absolutely.
Can you just quickly, since we use a global equity portfolio, can you kind of give a sense of whether, because we're looking at U.S. large cap, is U.S., the factors that we're looking at on this page, are they different than what you see in global?
No, so the answer for global, it's exactly the same kind of model. It's just the inputs reflect the markets that are being covered. So global equity is the expectation is down on almost exactly the same amount as our U.S. large cap equity is down. It's an almost identical shift.
Okay, any factor for foreign exchange, or is that not changing?
Oh, you've asked the wrong guy about that. You've just hit one of my deep topics of nerdery. And Mark is probably putting his head in his hands.
Grimacing.
There's all kinds of foreign exchange stuff that we provide in our capital market expectations. This is in line with market practice, which puts that off to one side. But we have detailed foreign exchange work that is able to be talked about in a more detailed process over the course of the next few months. So yes, we've got all of that stuff in there.
Okay, you just made Mark very happy.
Oh, yeah.
I think Mark had a question next, Ian.
I did have a question, Ian. Just could you maybe what is your source for your real earnings growth expectations? Is that market expectations?
Oh, goodness me. Yes. This is all taken from and this is really the job that the team does, is find the best sources for each of these things. So this is market expectations of real earnings growth.
Got it.
Okay. I'm sorry.
Oh, no, go ahead.
Ian, this is Bill Hancock. I see where we've got no change in inflation expectations. Is the expectation for us to believe the actual people that run the Fed that keep pounding the table and say, we're not going to stop until we get inflation to 2%? Is that to be believed, or are we going to be happier with something between 2 and 3?
Well, so this is an interesting question, because I'll answer your question, but I'll also generalize it about the nature of how we do our capital market assumptions. What we're trying to do with our capital market assumptions is take the least opinion-based approach to building these numbers, on the basis that gives you all, as you're making your decisions, the most non-opinion swayed starting point for the conversation. So we're not putting into this figure our own view of whether we believe what the Fed is going to do. And this is simply a combination of University of Michigan survey of professional forecasters, each of those at 25% weight, and then the TIPS break-even rate at 50% weight. So we're trying to take sort of as independent views from the marketplace of the inflation expectations. You are then, as board members, commissioners, and as investment professionals with the investment team, able to, if you so choose, introduce additional views into the level to which you believe, for example, the Fed is going to do what the Fed says. The goal of our capital market assumption process is to give you the starting point of that conversation rather than impose our view on the end result of that conversation. And Mark, of course, and I are there to help you with that discussion, but we don't want to bake those presumptions into these numbers as much as we can. Does that make sense?
Yes, thank you.
But I think you were asking if we think that inflation is going to settle in at a higher rate than the Fed's target rate.
I was not going to ask you whether you thought the Fed was lying or not.
No.
I was not going to ask that.
Ian's about to move Mark.
But I think what he was saying about higher for longer, we think that inflation is going to be stickier than many do.
Okay.
Not stickier at current level, but harder to get
down to that
2%.
2%. Yeah, it's not. We hope. Yeah.
And that plays into the higher for longer thesis,
Yeah.
right?
Yeah. Okay.
So And then private real estate, we've had some conversation about private real estate. We have been bearish about private real estate for the last couple of years, and from an opinion basis. Private real estate is getting cheaper for sure. Our suspicion in the short term is that's likely to continue. There's a bunch of assets that need to reprice. That means, of course, over the long term, that dropping in price is setting up higher expected returns over the long term. Because cheaper valuations likely increases cap rates and the prospects of decent opportunities coming from private real estate over the long term. But in the short term, we expect there's likely some pain still to be continuing there. On the next page. So that takes me to the end of the slides. In the appendix, we have a more if we click on there, in the appendix, we have a more detailed return methodology, just showing some of the main asset classes, where we get each of the building blocks, what each of the building blocks are, and how they add up to give the expected return. But I will stop talking now, and happy to answer any further questions, and we'll look forward to going through the full details of the book over the coming months as you do the planning process.
Any more questions for Mr. Toner? Well, Ian, I thank you for your input and the knowledge you share with us is valued here. Anything else for Mr. Toner on the ALM process? Nope.
I think that's it. And
Thank you all for your time. It's a pleasure to work with you.
Thank you. Looking forward to seeing you in March.
yep.
I'm looking forward to it. Thank you. Bye-bye.
Thanks,
Bye now.
Ian. Bye-bye. Get the shrimp and grits restaurant. Shrimp and
That's
grits.
right.
I was not going to mention that while he was on. That derailed him.
Yeah, we don't wanna.
Well, he would have gone on for another 20 minutes.
Yeah, right, yeah.
It's gone.
Well,
We don't wanna ruin his lunch.
Didn't want to do
'cause
that either.
Mr. Chairman, I got a related question,
Please go ahead.
and I didn't think this was Ian, that's why I let him go. And I don't know if this is really for Mr. Hitchcock or Mr. Brubaker. So if we're going to talk about the capital markets assumptions in detail in March, I mean, we need the capital markets assumptions, or Mike does, early in the year, January, say, because in March, he's going to present an SIOP for us. So I just wanted to make sure we were going to have it. And at the March meeting, it was already going to be incorporated into our draft document.
Perfectly timed.
Yeah, perfectly timed. I
We
got
got the email that.
Oh, I set something up again?
They were released yesterday.
They were released yesterday.
Oh.
If they would have been released 2 weeks ago, we could have had them a little more of a discussion today. But
Oh, okay.
They have been finalized, they're released, and
Yeah.
Jeff and Mike have.
Can I pre-file a question that I'd
Yeah.
like you guys to make sure that you feature? It's a legal term, like. The distinction between US equities and global equities, and I don't know the history of your recommendations, but we have seen for probably 10 years in a row, the expectation that global is going to remind us why we
it's
use
higher.
global.
Yeah, oh,
So can you just make sure that when we have that conversation that we give some specific bearing to that?
yeah,
Question.
we definitely will. We are proponents of using a global allocation, and if you look at our assumptions, even though Ian said that they moved in similar direction last year, our return expectations for international stocks are significantly higher right now than they are for US stocks.
Yes, I was noticing that there's a significant difference between the expectations, to give a preview between,
Right,
large cap US and, global.
right.
I'm reminded by a lot of firms, sort of the widowmaker of the last 30 years is get ready to invest in Japan.
Oh, yeah.
You know?
Hey.
And lo and behold,
It's happening.
it's 27 years later, it's finally happening. So I just want to make sure we have that,
Well, that was,
part
and
of
then when I first saw, Japan was gonna take over the world when I
Yeah,
first
yeah,
started,
yeah.
so
They
it's,
bought Pebble Beach.
yeah,
So,
Aren't they saying the same thing about China now?
yeah,
so,
All right.
all right.
Moving on, are we ready Yeah, I think, let's go to item number 7, and we'll recognize Mr. Berg again, and he's going to walk us through the Delegated Investment Report.
As you can see on the screen, Mr. Chairman, we did not close a new investment between the last meeting and this meeting, which makes this, I think, the very first time that we have not had a delegated investment report. So,
Okay. Next up, I'm going to call on Mr. Hitchcock to read a motion for us to recede into executive session. Would you read off that motion for us, please,
Yes,
sir?
Motion to proceed into executive session to discuss investment matters, including specific co-investments and private debt investments, and certain portions of the consolidated annual investment plan and statement of investment objectives and policies pursuant to SC Code Sections 91680 and 916.320, to discuss personnel matters pursuant to SC Code annotated Section 30-4-70A1, and to receive advice from our esteemed legal counsel pursuant to SC Code Section 30-4-70A2.
May I have a motion?
So moved.
I have a motion. May I have a second?
Second.
I have a motion and a second. Do we have any discussion? Hearing none, all in favor of receding into executive session, please say aye.
Aye.
All opposed? All opposed likewise? The ayes have it. We're now in executive session. I would ask that the staff take appropriate measures.
You want to take a short break? All right, we're good.
Okay. All right, we've come out of executive session back into open session, and action resulting from executive session. We're gonna put a motion on the floor. Mike, can I get you to read that for us, please?
Yes, Mr. Chairman, just for the record, the commission took no action in executive session, but as a result of discussions in executive session, there is a motion for open session to consider. And the motion would be to adopt the recommendation of the CIO and staff to adopt the rebalancing ranges for bonds as discussed in the executive session to lower the minimum bonds allocation from 15% to 10%, with the 10% allocation continuing to be comprised of investment-grade bonds, and to direct that the changes be incorporated into and made a part of the consolidated annual investment plan and statement of investment objectives and policies, and authorize the staff to make any technical revisions or formatting edits consistent with the action taken by the commission. The CIO will provide the commission with notice to the extent he takes action to reduce the bonds allocation to less than 15%.
May I have a motion?
So moved.
I have a motion. May I have a second?
Second.
I have a motion and a second. Do we have any discussion on this motion? Hearing none, all in favor, please say aye.
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 Any opposed, same way, likewise? The ayes have it, it carries. I think all that's left to do now is I'm gonna call for a motion to adjourn.
So moved.
I have a motion to adjourn. Do I have a second?
Second.
Second.
Anybody, any discussion? All in favor of adjourning, please say aye.
Aye.
All opposed?
Aye.
Merry Christmas.
Merry Christmas.
Happy holidays. Safe travels to all you folks.